I'm research analyst Nick Antonucci with Henssler Financial. On this edition of MoneyWise, we'll be covering the topic of risk tolerance and what it means to your investing style as you construct your own portfolio. Now, a person's risk tolerance describes their willingness to take risk and stomach the sometimes large ups and downs of the market. Generally speaking, a person falls somewhere on the spectrum between conservative and aggressive with a moderate risk tolerance in the middle and other variations sprinkled in between. The simplistic way to think about it is the higher the risk, the higher potential reward. Now, you don't want to take on too much risk, but you also don't want to take on too little risk either and not meet your retirement goals. It's about finding the balance for your individual circumstances. A person's risk tolerance is not static, but instead it changes over time just as our personal circumstances change. Age and investment horizon often come into play, meaning that someone who is 40 years from retirement, or when they will need to begin drawing on their investment, has the ability to take on more risk than someone who is near or in retirement. Now, when you're 20 years old, you may feel more comfortable taking on considerable risk, but that doesn't mean you shouldn't adjust your portfolio's allocation as you move closer and closer to retirement. As you approach the time when you'll need to start drawing on these funds, the amount of risk you take should be reduced. So how do you determine what your risk tolerance is? Internally, we provide our clients with a questionnaire consisting of 7 questions that give us guidance as to what your risk tolerance is. These questions address expectations for growth in investments, knowledge of financial markets, age, and time until the money will be needed. These are all questions any investor should ask themselves and answer honestly. So to give an example, ask yourself, what do you expect from your investments in the next 3 years? Do you mind if your account loses money? If so, is a small loss okay? Or do you require at least a small positive return? If your answer is the latter, you likely fall closer to the conservative end of the risk spectrum and should invest accordingly. So what does that mean? Well, investors have the ability to invest across various asset classes. Think stocks and bonds for simplicity's sake. Now, within stocks, you can further classify a security by its size, large, mid, small, its style, meaning growth or value, whether it's domestic or international, and we can even break these classifications down further. But how do we measure risk across asset classes? 2 of the most common measures of risk are beta and standard deviation. In its most simple form, beta is a measure of the volatility of an individual asset in comparison to the overall market. Standard deviation, on the other hand, measures historical volatility of an investment with a greater standard deviation indicating a greater variability in returns from their mean. In terms of risk, small cap stocks tend to be more risky than large cap stocks, and stocks as a whole are more risky than bonds. Now, that's not to say all stocks are created equal, nor are all bonds. For most, some sort of mix between stocks and bonds is appropriate, as investing across asset classes helps provide a diversified portfolio, which helps to achieve strong returns across a market cycle while also smoothing out the highs and lows as different asset classes move in different directions at various times in an economic cycle. So now let's put it all together. If I've discovered that my risk tolerance is more conservative, it makes sense to invest more of my assets into the less risky asset class, bonds. Now, that's not to say that I don't own any stocks, but history shows greater variability in stock returns than bond returns, and therefore more risk. If I'm a more aggressive investor with a very long time horizon, perhaps an allocation that's almost all stocks is more fitting for me. This has been your overview on risk tolerances, a continuation of our MoneyWise Financial Literacy series brought to you by Henssler Financial. I'm Nick Antonucci. Thanks for watching.